Hi, we're going to get a little more complicated now. We're going to use a strategy called Bollinger Bands. Now, these are like a lot of things that we see, like they're just a study. So take a look on the side here. We have all kinds of different studies, from moving averages, which I listed on the chart, to things that we've never even heard of, like the Harlan Index and the Herrick Payoff Index. I don't even know what these are. So we're going to use something called Bollinger Bands, which project a moving average, and then they put two bands around the moving average that the distance between them are they are two standard deviations away from the moving averages, just plotted above, plotted below. And standard deviation, that measurement is just take a basic statistics course. It's how the values deviate around the mean. So standard deviation, Bollinger Bands usually goes with about a 20-day standard deviation. So it's how the values actually deviate from the 20-day average. So that's your standard deviation. Like I said, grab a statistics book if it's a little annoying. So first I'm going to show just a simple price channel. So we have our price channel, and I'm going to get rid of the moving averages just to make sure not to complicate things. We're going to have our price channel of 20 days. That's why, like, PC20. Now this shows that it shows over a course of 20 days the high and the low. So for instance, I'll move in here. We have a little over 2 months going on. You see right here, there's a high that's made here, and the price channel carries on for the next 20 days, that high value, and then it moves to the next highest value and the next highest value, so on, until a new high is made. Alright, pretty simple. And then when a new high is made, the price channel moves. Same thing goes with lows. This was the low right here, and then 20 days go by, that gets knocked out right there, dropped off these values, and then it goes to this value. So there. Now you can develop a trading system on this, but the issue is it doesn't take volatility into account, volatility of a stock or an option or a future. So that's when we use the Bollinger Band. I'm going to get rid of the price channel, and we'll toss in a Bollinger Band. And see, we have edit study. This is our standard deviations here. Like I said, 2, that's usually a general. The bar period, that means 20 days, 20-day standard deviation, that the values are going to be taken into account for the current day. And I like to use the close because that price represents the price where all accounts are settled for the day. So I always find that the most important. So we have our Bollinger Band, and as you can see, it already looks completely different from the price channel. Like, the price channel looks like it's the green and the brown. It looks like that. Alright, so I'll get rid of that. Now, when we do these studies, I usually like using the basic trend techniques, like I was showing the triangles or price patterns or trend lines. These usually get a little they're not as dependable usually. I'm going to toss in a quick moving average. Moving average, simple moving average. There we go, simple moving average, and I'm going to do the same period as the Bollinger Bands. So we see, there we go. We have standard deviations from the moving average, which is the mean. Alright, so like I was saying, this strategy isn't as dependable, but it sometimes works, sometimes doesn't. The idea behind it is when the price goes behind, when it goes above or below one of the upper or lower bands, it usually signifies that a new trend is in place or a trend is continuing. So, and we usually like to go with the closing price. So we take a look here you can use the closing price actually if you're more conservative, the opening price if you're a little more aggressive, but the risk difference isn't too much. So our trading signals for buying in are when the price touches the upper band. So upper band, there's a touch, and there's a touch, and there's a touch, and one there, and we see one here. And if you haven't noticed yet, we're using Pennant Park Investment Corporation, PNNT, which personally I like the stock. I actually did another video on it with trend lines just a bit ago. So we take a look. Here are our entry points, and I'll put one more, and I'm going to change the color purple. Actually, we can see it. These are all the entry points that we have. As you can see, what we have that's a good entry. That's showing there's an uptrend, and sure enough, the price went up. So it's staying in the uptrend, consistently closing above the line. It doesn't need to close consistently above it, but it's just nice if it does. And then this would be another buy signal. Now, this one is a false buy signal in the short term, that is. So when this happens, when you buy in, you want to close out your order, like in this case, sell what you bought, or at least that position that you bought. I'd keep that one just in case, and you liquidate the rest of it when it would touch the lower band. With this, you would exit right here at the moving average, and then here, get rid of the rest, and then here, unfortunately, you'd have to ride it up a little bit until you get to the next buy point, which is right there. So you buy there, goes up again, you're making some money, goes down, moving average, get out again, and then once again you'd have to ride the trend, see what's going on, it's going sideways, and then you have another buy point right there. And then that's your final buy point. At this point, you are making some money, since all of your losses you're cutting very short, so you usually don't need to worry about that. And then, sure enough, goes down. We wanted to sell here, and there we go. There's the May correction. Downtrend, 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 and then right here, our next buy signal. We bought in, it's going down again, and depending on if you're conservative or not, or aggressive, conservative, you can sell at the moving average. Aggressive, you can sell when it touches the line, which it never did. And then keep waiting, and then there's another buy signal. Keep waiting, that would be a sell signal, and then a buy signal. Like I said, it's a strategy that it isn't as dependable as other ones we see. Like, I'm going to get rid of all of those, and I'll circle our sell signals. Yeah, these are our sell signals here. No, that's not one. And right here. But yeah, like I was saying, this one's not as dependable, so I like to use it in conjunction with other things, like other signals. So it's mainly for the program traders. So like I was saying before, we have a line right here, and I can draw a trend line with it. Actually, I'll draw a trend line. I'll take this trend line, for instance. I'm going to X that out. We can draw this trend line. And when I see that there's a buy point right here, and I see it cross below this level and break the trend line, that tells me major red flag. I want to get out completely as soon as it breaks the moving average. Not only that, I want to sell short, and then I can buy back once I can cover my short once it gets to here, because perhaps a new trend is in place, and that'd be conservative, but just in case, you can know the higher highs, higher lows right there, and then affirming the new trend, which is certainly up. Sorry for the blues. Quickly flip that around. Green. So Bollinger Bands in conjunction with something else, great strategy to use, because then you have a weight of evidence in your favor when you make a trade. Alone, not very dependable, but still useful. Alright, stay tuned for the next one. Hopefully I didn't get too complicated with things. Any questions, just go ahead, post in the comment box. Thanks for watching.